Good afternoon, I'm Catherine McQueen, and this afternoon I will be hosting Blue Whale's first ever live Q&A event for investors. I am joined today by Stephen Yu, who is the CIO of Blue Whale Capital and lead manager of the LF Blue Whale Growth Fund. Thank you for joining us today, Stephen.
Thank you, Catherine.
There was a limited number of spots available and the team is humbled by the level of interest. Thank you all for your questions. We will try to answer as many as possible, but we may not be able to cover all of them in the time available. In regards to the outline for today, I have divided your questions across 5 subheadings so that the conversation is more fluid and easier to follow. These are market outlook, fund performance, investment process, stocks, and Blue Whale Capital. Please note that you may also submit questions live via the app's chat function during the first 30 minutes of the session. The last 20 minutes of the event will be dedicated to questions that we receive live. In case you'd like to review the Q&A session, a recording will be made available to all those that signed up to join us. Finally, I would like to remind viewers that this financial promotion is intended for UK residents only. With that, I'll start with the first topic for the afternoon, which tackles questions covering the market outlook. So, first question. Many commentators are predicting a crash in 2021. What is your view and what is your strategy to deal with this? That's from Nigel in Hazelmere.
Thank you, Catherine, for the question. I think maybe my first answer would be yes or no, depending on what you're looking at. If you're referring to some of the headline stocks, such as like GameStop, like Tesla, or even the recently IPO companies like Airbnb, DoorDash late last year, we definitely see that the fundamentals of those companies have been quite detached from the share price, which you can consider them in bubbly territory. But then if you're looking at our companies in the fund, about 30 names in the fund, that we do not feel that there's any company that trading at an extreme valuation. So we feel that our holdings has been quite reasonably valued for the quality they are. And at the same time, if we do have some sort of bubbly territory in the holdings that we own, we would probably have done even better. And we have not. So we are very comfortable with the holdings in our fund. But then what can we do about this is about, I think the first and foremost is you avoid those companies that you feel they are not trading in line with the fundamentals, so avoid those stocks at all costs. But then secondly, if the market ended up giving you the opportunity, which means, let's say, if Tesla goes down by half tomorrow, and obviously a lot of stocks would be quite correlated with each other, and that would give us opportunity to invest more into the companies that we have in the fund at a cheaper valuation. So that's what we have got.
Thank you, Stephen. So we have another question, and that is, have you changed the portfolio composition in response to inflation fears, or is it just short-term noise? That's from Joshua in Beckenham.
Inflation has been quite a big topic since Q4 last year when we had the vaccine news that came out, and also at the same time Biden was elected in the US. And there's a lot of talks about reflation in the market and economy, etc. But then I think the first thing that people need to understand is where's inflation coming from in the next couple, probably 6 to 12 months from here. And it's not difficult to understand that when we are in a lockdown mode in terms of economy, and when you have a lot of restaurants and shops or even airlines disappearing or cutting their capacity, as soon as the restaurants and the airlines or holidaymaker open up for people to go travel and go to restaurants again, you would expect that the prices will be going up, right? Mm-hmm. Like in the past, you might be paying, let's say, 20 quid for main course. I'm sure like when you go to a nice restaurant again in a few months' time, you might be paying £25 for main course. And I think people would be willing to pay for that. And so the question is, so what is going to happen after this? So is this just like a one-off, which we feel from Blue Whale perspective, we feel this is a one-off inflation because it's people just being water spent for a bit of time. But there's no evidence to date why after the economy reopen up again, that the inflation would be higher than the pre-COVID era. So before COVID, I think inflation has been quite manageable, about 2-ish% in the US or in the UK. And if you look at the wages, how much we get paid working, it hasn't been going up a lot neither. So in terms of I think there's a lot of argument about technology is helping the world to be more efficient. You can do more things with less, and hence inflation could remain quite low over the long period of time. So basically, the way that we see this is we don't disagree that will be short-term inflation in the market, and we're not worried about a short-term inflation blip. And we took the view that we don't feel that this is a sustainable high-level inflation over the medium term. Hence, we're not changing our strategy.
It's good to know. Thanks, Stephen. How do you envisage the ongoing rotation from growth into value will impact the LF Blue Whale Fund? That's a question from Jonathan in Kettering.
This is a very big topic it's been quite popular topic recently about value versus growth. And obviously, I think if you look at the last 10 years, company that can grow or have the ability to grow have done extremely well versus company that cannot grow, which they are typically in the value bucket. But I think the first thing for us to understand is what define a high quality business is. And one of the criteria that we need from a company is they have the ability to grow with new products, taking market share, expanding into new territory, etc. And also at the same time, pricing power. And if you can't do any of this, that means that it's unlikely that you can grow as a company to make more money. And to us, we would deem those companies as quite low quality businesses. And typically where the argument sits now is typically for those lower quality businesses or highly cyclical businesses, they would be trading at a very low PE multiple on a headline basis. So you're talking about the next 1 to 2 years, you will have seen companies trading at maybe 10 times, 15 times versus company that might be trading at 20 to 25 times that can grow. But to us, like we would deem those companies as quite low quality businesses to start with, and we're not interested. So, but recently, I think we can't disagree with the market. There has been a bit of rotation that some allocators or some investors have been overly excited about. Maybe we should now be investing into airlines, into energy company, into oil and gas mining company, just because that there's some level of inflation. But that is not sustainable. So it doesn't change anything about the company being a high quality business. They will just go through cycles and cycles, and they will have some period of time they will make a lot of money. They will have some period of time they loses you a lot of money, and we're just not interested in that area of the market. So we would rather stay with company that can grow, and they're high quality businesses, and they're making good monies or delivering good return for shareholders like us.
Thank you. We're going to move on to the next section now, which is questions relating to fund performance. Your 3-year performance has been spectacular. Is your diversification sufficient in the event of a bubble bursting? That's a question from Graham in Romsey.
So in terms of diversification, I think if you refer to some economic study, 30 to 40 stocks is where you get the most diversification in terms of running a portfolio. So I think from our perspective, investing into the best of 25 to 35 names, that we feel the diversification purpose has been served within the fund. And how do you avoid bubbles? I think I outlined earlier is like you just make sure that you can avoid those companies that are not trading in line with fundamentals. And it's not about how many stocks that you have in the fund, right? So let's say if we are running like 100 stocks portfolio, and 100 of those names are the bubbly stocks, like you have like 10 multiple of Tesla, you have multiple of Airbnb, multiple of DoorDash, etc., then that diversification means nothing, right? So it all goes back to what you actually own in the fund. And we believe that the 30 names that we have in the fund as of today, they are very high quality businesses and their valuation are quite reasonable. And last but not least, I think it's worth pointing out that most investors, typically they would invest into more than one fund. So I wouldn't expect that someone would just have maybe 100% of their investment tied to the Blue Whale Growth Fund, for example, I mean, they would be holding 5 to 10 funds across different asset classes. And the way to get most diversification from an investor perspective is to invest into different asset classes. So Blue Whale being a global equity fund, we are one of the asset class. And I'm sure investor would have investment in some sort of property or the places that they're living. And they might be investing into a fixed income product as well, et cetera, et cetera. So basically, that is how you get the most diversification if you're talking about investing from your personal perspective. But from our perspective, I think 30 to 35 stocks is perfectly fit the purpose.
Thank you. Why did the fund perform well during the 2018 downturn? And do you think this can be replicated in a future correction? That's from Mark in Cheshire.
Yeah, this is a very good question because I think last year that we have done quite well, relatively well, relative to a lot of peer group. And we have been asked a lot about, because Blue Whale has done well because of digital transformation, because the interest rate was low, et cetera, et cetera. But thank you for this question that we should remind our investors that back in 2018, the Fed was raising interest rate in Q4, and that's the reason why the market was in a negative territory, and the fund was in the positive territory. And so we have gone through quite a few mini cycles over the last 3.5 years we started. So we had the Fed raising interest rate in 2018. We had a very strong bull market in 2019. And then we have the pandemic last year. And we have the Fed cutting interest rate. And now maybe there's an expectation they could be raising interest rate in the next 12 to 18 months. So I think, but what is interesting is we have not changed our approach, that we like companies that are quite high quality. And another way to define high quality is we want that earnings growth trajectory to be independent from any of these macro uncertainties. So whether interest rate is at 2% or at 1% or even 3%, our companies will still be able to deliver the earnings growth trajectory that we expect them to do. If that is the case, then it's more likely that the share price would behave in a similar manner, which means that we should be able to do better than the market. So I think if you put all this together, that we always try to be able to do better than the market. But one thing for any investor, you should remember that this is a long-only fund. This is not an absolute return fund. So if the market is going to be in a negative territory in a quite severe manner, that this fund will lose money. And we have seen that in Q1 last year, during the pandemic, the fund was down about 8% in the first quarter, and versus the market about 15%. So we have done better than the market, but we still lost money in that quarter. But luckily for us that we have made up all the losses in Q2 and Q3 afterwards. So I think it all comes back to your time horizon, that if you're asking us, can we protect losses in the next 6 to 12 months, I think that is out of our hands. But if you take a medium-term view in terms of investing in our fund, which is a recommended period of 5 years, then I think that hopefully that we should be able to make money for investors.
Thank you. History has shown us that funds start off great and beat the market, but then continuously fail to do so. What are you doing to ensure that this does not happen to Blue Whale? That's from Adam and Lester.
It's always possible that people can, including us, could be one-time lucky, and it's also a question that we keep asking ourselves, whether we have any sustainable advantage versus our competitors or any other funds that we are competing with. And I would give you one scenario. This is quite similar when we look at high quality businesses, because you could be looking at, let's say, the likes of Amazon 10 years ago, and then you would say, Amazon has done well because Jeff Bezos was working quite hard. They came up with all this innovation. They have been expanding their market share in different country, etc. And then at some point, Amazon would stop being a great company because they just got lucky that they have managed to do that within that time horizon. But then I think the history have shown with hindsight that Amazon have continued to innovate and take market share and continue to come up with better products, services for consumer like us, and we like them even more. So that competitive positioning as a company in the space that operate have actually improved dramatically over the last 5 to 10 years. And as we speak now, it's continued to improve from this point onwards. So what do we do with Amazon? A company such as Amazon is you can't just sit back to say, okay, we have done our research, we know what they're doing, and then we just never look at that again in the next 5 to 10 years. You can't do that, right? Some things could have changed, and that's what happened with a lot of great businesses. And at some point, they just stop being a great businesses and become maybe lower quality. So that is the process that we do when we look at companies. So I think for investors like you investing into fund like us or some other holdings, I think you should apply the same process. And that's exactly the reason why we are here today to answer your questions. And what we're trying to do is to help you to understand what we want to achieve for this fund and how we think about things. But if at some point that we fail to deliver what we set out to do, then maybe you should be voting with your feet and sell our fund. I think that is why we're putting ourselves on the line here, that if we do well, hopefully we would receive your support. But if we stop doing well, I think it will be wrong to ask for the support, because that is the kind of why we're here in the first place.
Yeah, good answer, very honest. Well, that concludes the questions under the second topic. I'll quickly remind viewers that they have until 1:30 to submit any questions which they would like us to cover in the second half of the session. Starting with the third sections now, questions about the investment process. So the next question is, what's the greatest challenge of managing a portfolio with a fairly low number of stocks? That's from Nathan in London.
Going back to my previous career, I think the greatest challenge about running a high conviction portfolio is about the resource that you have. And at Duwell, there are 5 of us in the investment team, so we don't feel that is a challenge. But the way that you can think about that as an investor is we are very focused investing into 25 to 35 companies. And typically, I think when you are running a global fund or some other funds, if you're not managing a lot of money, typically you don't get a lot of people in the team. So let's say if you only have 2 people in the team covering about 70 stocks versus, let's say, 5 of us covering 25 stocks in the fund, you do the maths to work out if each of one of us work 10 hours a day, multiplied by 5, divided by 25, versus another team, which you only have 2 individuals covering 70 stocks, less focus. And the output would tell you that we would be spending about 7 to 8 times more per company per month versus some of our competitors. And so I think that is the greatest challenge. And how did we come to that decision in the first place to have so many people in the team is a decision that Peter Hargreaves and myself made at the start when we were managing for a small sum of money. And that's an investment that we made as a company. And I think that's very important. So once you have the level of resource to do the work, then I think the next 2 things is actually it works hand in hand. That when you're running a highly concentrated portfolio, that you become more disciplined, that if you have you have a new ideas that's sitting on the sideline that you really like, you really need to ask the question, is it better than the 30 names that you have in the fund? Or even if you're sizing the position, you might want to say, oh, I want to invest more in this company, but then you would, because we have limited capital, then you will be taking away the capital from another company which would also be in the fund but may have a bigger holding. So I think once you have the resource to do all the work, it actually works quite beautifully that at all times that we want the fund to reflect the highest conviction ideas that we have outside within our investable universe.
Thank you, Stephen. Next question. So how does the team account for short-term market sentiment versus long-term fundamentals when assessing valuations of underlying stocks? That's from Tom, who's also in London.
Yep. So we do not define risk as volatility of share price. We define risk as permanent loss of capital in line with fundamentals of the company. So basically what happened is, I'm sure we have seen it recently in terms of the market movement, and we definitely have seen it many more times over the last 3.5 years that we have been around, that from time to time the market could be quite volatile in terms of rotation from value to growth, or the market become quite excited about reflation, etc., etc. But then that is share price volatility. We would be asking the question, is that reflected in any shape or form based on fundamentals? And if the answer is not, then we would take the opportunity based on the share price volatility to invest more into those companies at a cheaper valuation. And if I give you one example, is about Microsoft. About this time last year, that during the COVID sell-off in February and March, at one point Microsoft, the share was down about 25% from peak to trough, in line with the market, S&P 500 index. But then when we have done the work, you try to estimate what sort of earnings downgrade would we expect from Microsoft versus the S&P 500 index. And obviously the S&P 500 index would include the likes of a lot of highly levered companies, airlines, energy, oil and gas, etc., etc. The estimate that we got to would be about over 20% for the market in terms of earnings downgrade. The actual number would be about 30 with hindsight now. But at the time that when we have done the work on Microsoft, which is a big holding in the fund, the earnings downgrade would be less than 5 to 10%. The actual number is actually just a few percent downgrade in 2020. So basically, when you have the shares going down 25% with the earnings downgrade of less than 5 to 10% versus the market down similar, but with earnings downgrade about 20% plus, then you will be arguing that Microsoft was trading at a very significant valuation discrepancy to the market at the time. So we took the opportunity to invest more into Microsoft at a very attractive valuation. So basically, the answer to your question is we like volatility in the market, and we see that as an opportunity, as long as it doesn't affect the fundamentals of the company that we invest into, then we are not worried about volatility.
That's a good way to look at it. I note that PayPal has dropped out of the top 10. May you explain your valuation methodology and sell discipline? That's from Nazrov, who's in London.
Yep. So just to remind our investors that after we have done all the work on a company, and we already talked about that, there are 5 of us, we spend quite a lot of time researching on the company, we would translate our understanding into a financial model. So for every holding in the fund, we would have a unique financial model for those companies, taking into account the industry they are in, how we factor in geographic split, the margin expansion, etc., etc. And then we would try to forecast the earnings over the next few years for this company. So one way to gauge valuation is whether we have a differentiated angle in terms of our forecast versus the market expectations. And if I just give you one example, that you could have a company trading at, I think some people look at PE ratio. We never look at PE ratio. It's quite a low quality metric when you talk about valuation, but just to use it as a scenario. So you could have a company that's trading at 15 times, 1.5, versus a company trading at 25 times PE ratio 2 years from today. And people will say, oh, this company trading at 15 times is cheaper than 25 times. I think most people would agree with that. It's cheaper. But is that really cheaper? We would disagree that it's cheaper, because it would depend on the market consensus in terms of the forecast. So basically, if we forecast this company trading at 25 times, that our earnings forecast is 10 to 20% ahead of the underlying earnings, the PE ratio, the YE, then it means that the 25 times number that you're looking at is incorrect. It could actually be maybe 18 to 20 times, because we are much ahead of the market consensus. On the other hand, when you have a company trading at 15 times and then you think it's cheaper, but then if our research proves to be correct, that we could be forecasting this company is going to make 10 to 20% less money compared to what the market expecting. So if you put our numbers into that PE ratio, the earnings as a denominator, it could actually be trading over 20 times. So to us, that that is the incorrect assumption, and obviously it's an easy way to gauge the valuation of company, but it's all about the fundamentals. It's all about the numbers that you put into that fundamentals. You can put any numbers and it will just give you the incorrect answer. So I think that is what we do. And the reason that PayPal have dropped out from the top 10 recently is valuation. And as I outlined earlier, that we have some new holdings. I think I'm sure we're going to that a bit later. That in order for us to build a position in a new holding, then something has to give. And looking at the performance of PayPal since last year, I mean, it was up over 100%. And on our valuation framework, we still feel that the valuation is reasonable, but then it's not as attractive as 12 months ago compared to some other holdings that we are putting your money into now.
That's really interesting, thank you. Tech stocks have been at their strongest during the pandemic, but how important will they be within your portfolio going forward? That's from Robin in Maidstone.
Yep. So when we first started 3.5 years ago, we started with a blank piece of paper, and we didn't have any in terms of the kind of like a understanding that maybe we should have what we have now 3.5 years later, in terms of about 50% of the fund is in technology related names. All of this has been built up over time. And I think one thing that we have learned over the last 3.5 years is we definitely have liked a lot in terms of company that could facilitate digital transformations. And there are two big themes. I think now everyone understood it after the pandemic, is working from home, which is the likes of Microsoft, Adobe, Autodesk, etc. And then you also have the e-commerce, which is shopping online. That's the likes of Amazon and PayPal. But obviously, it wasn't very obvious at the time when we first started, because a lot of people will still be going to the high street, people will still be working in the office, and will say, oh, I don't actually need this. So that is something that we have picked up since we started. And the more work that we have done in those areas, we discover that these companies are quite high quality businesses. And if I give you one example, which is Microsoft, is the company that I referred to earlier, is one of the highest quality business that we have in the fund, is net cash, very high margin, very scalable in terms of the business model. Everyone is basically adding the Office 365 if you're an office worker, etc., and then you're paying Microsoft a fee on a monthly basis. And there's not much cost to manufacture the product. It's the same product for everyone. In contrast, if you're producing a kit, then you would have a bit of manufacturing costs on an ongoing basis. So I think software companies such as Microsoft is actually very high quality, and that is not going to change. In contrast, I think if you're referring to, I mean, we do have a small investment in Unilever in the fund, which we deem as relatively lower quality business versus the life of Microsoft. And a lot of things have changed for Unilever. I think if you look at Unilever about maybe 10, 20 years ago, it would definitely be superb quality, because they have pricing power. Everyone is going after the products in the developed market like us in the UK. But something have changed over the last 10 years, that all the supermarkets have now come up with their own brands, and I think people trust those brands much more now. There's a lot of competitions in terms of disruptors coming into the market, because they no longer need to rely on the supermarket to distribute their products. They can sell to us directly online, so they can build up a lot of traction. So Unilever, while it remains a good quality business, it still delivers about 20% return on invested capital, but it's significantly lower quality versus the likes of Microsoft. And I think the pandemic have definitely given Microsoft a massive leg up in terms of people signing up on Teams, people using more of their service, etc. So I think that is the high level take on technology. But as I said at the beginning, there's a lot or many more technology names that are trading at extreme valuation or in a bubbly territory, and then their business model are quite low quality. I'm happy to expand on this if people are interested in the live Q&A part. It's the likes of like Netflix, Zoom, which we're using today. We dislike them a lot in terms of business model. I mean, we're paying them today, fine. And then like Uber, Deliveroo, which is about to list in London. I mean, those quality of the business are quite low. So they are technology, but we're not interested. So I think we are highly selective on that front.
Well, let's hope Zoom doesn't let us down. That's us just past the halfway mark of the webinar. It's just gone past 1:30, and we have another question, which is how much consideration is ESG given in investment choices? That's from Paul in Newbury.
We consider ESG as a risk factor to determine whether a company can continue to deliver high level of return on invested capital. And the way that we go about this is when we look into when we research on our company, we'll be asking the question, are these companies causing harm to the environment, such as like a coal mining company, which we would never be interested? Are they selling products that are killing people in terms of, let's say, smoking products? Or do they have weak corporate governance, which is one of the ways that we define high quality businesses with a good management team? So I think if the answer to those questions are yes, which makes them very low quality businesses, or ESG unfriendly being to ESG, then we would not be interested. But on the other hand, I think typically when you invest into high quality businesses, you would find that they would be in a quite good shape in terms of the corporate governance, in terms of how they interact with consumers, how they are being quite caring to the environment, that they do the right things. And so I think that's the way that we look at it. But I think one thing just to caveat that this is not a ESG high impact fund, so we're not actively seeking for companies that might be doing good to some of this area, but we expect them to behave sensibly within the framework.
Yeah, I think it's expected of everybody now, really, isn't it? Thank you, Stephen. That's it for the investment process questions. We'll now tackle stock-specific questions. What do you like about New Holdings, Moncler and Nintendo? That's from Stephen in London.
So Moncler is, we do cover the luxury brands, and so we don't just invest in technology names. And Moncler is one of the companies that we do like since we started the fund. And one thing that's happened in Q1 last year, as we talk about that, when we built financial model, we make forecasts over the next few years, and we dislike companies that are quite that are being impacted by macro uncertainties, such as pandemic. So we actually sold out of Moncler in Q1 last year, and then we put the money into the likes of Microsoft, PayPal, Amazon, etc., with higher certainty in terms of what they can do during the pandemic. But then during the summer last year, that we revisited the valuation for Moncler, and then we initiated a position in Moncler. And since then, it has become a top 10 holding in December and January. And the valuation was very attractive at the time. And obviously, they have pricing power if you're worried about inflation, if you're expecting that the economy is going to open up, we're going to for our next ski trip or coming out, then yeah, the luxury brand would be a good place to be. Nintendo is an interesting one, is a recent top 10 holding, which we have written about. If you go onto our website, you will be able to see a short commentary on that. The reason we like about Nintendo, I think everyone is familiar with Switch, and you know all the characters like Mario and Zelda, etc. And one thing that we feel that we might have a differentiated angle on Nintendo is that the Switch could become like the equivalent of iPhone about maybe 5 to 10 years ago, that it could be the standard for Nintendo. So the problem for Nintendo, or let's say Apple in the past, is when you come up with a different products all the time, that is very difficult to build traction in that product. But if you started to have a product that would only improve on an iteration basis, which means that, let's say, iPhone model is the same kind of operating system, and then you will be able to build traction and be able to deliver high return on invested capital. At the same time, for Nintendo, that they are quite behind in terms of digital download, which would give them higher margin, and so we it's trending towards that way, and we like the fundamental side of that. So, and then if you marry the valuation of Nintendo where it's trading at now, we feel that it's quite attractive. So as we said earlier, that we would rather have bigger position in Nintendo today versus the likes of PayPal, right, which we still have in the fund.
Yeah, thank you. Do you expect that the strong performance from Microsoft and other tech stocks to come to an end? That's from Richard in Petersfield.
It depends. So I think if you ask the question whether Microsoft would be able to deliver the same level of outperformance in the last 3 years versus the next 3 years, then the answer is no. Because 3 years ago, the valuation for Microsoft would be significantly cheaper. That's when we first started the position. But then if you're asking whether Microsoft will continue to do better than the market over the next 3 years, I think from our perspective, we feel that the answer is yes, but it will be less in terms of magnitude. So the question that we are really asking running a high conviction portfolio is whether we can find something better. If we can, then maybe we would have either a smaller position in Microsoft, or maybe we could be selling out of Microsoft. But for the time being, we don't feel we are there yet, but we continue to revisit the portfolio at all times.
Thank you. May you explain your rationale for holding Amazon? That's from Michael in London again.
Yep, there are two parts to Amazon. I'm sure everyone is familiar with Amazon now. One is the retail business. The other part is the cloud AWS business. We don't really like the retail business, which is basically when we go onto the go onto Amazon.com to shop, and it's a highly competitive area. They have done quite well in terms of, I think, pioneering a lot of things that they have done. It's definitely much better than a lot of other competitors that the industry they are in. But it doesn't change the fact that it's still like a retail business, that every delivery they make to us, they make less money, right? Because there's a lot of shipping, refunding, etc. But then for the cloud business, which is a much higher margin business, they're the number one cloud provider in the world, leading the way versus Microsoft and Google, and that's not going to change. And they do, and it's very scalable in terms of how they operate. So within, I think, Amazon, that we like the company as a whole, but if we were to pick one of those two businesses, and maybe in time we get the opportunity to pick one, given that that could be some sort of like a, I don't know, like a breakup scenario, then we will pick the cloud business versus the retail business.
Thank you, Stephen. So we're at 1:40 now. We've got another question here. With all the negative press surrounding the stock, why do you hold Facebook? That's from Paul in Newbury.
There are two parts to Facebook as well. One is the Facebook page slash Instagram. The other part to the Facebook is WhatsApp. So I think if we are talking about regulation in general, is good for the incumbent, such as Facebook. So it means that more regulation means less disruptors coming into the market to start a new social media platform. But then I think if we're referring to some sort of regulation or breakup for Facebook, it's very similar to Amazon. I think it's good for shareholders. I mean, WhatsApp, they're not making any money from WhatsApp, and you have over 2 billion users. I think everyone is a user of WhatsApp. And they have just made the announcement that they're going to make WhatsApp call available on desktop as well. So you can use WhatsApp to call your friends, just like you use Teams from Microsoft, etc. So I think we do like the business for Facebook. And I think if you look at the valuation of Facebook, there's a lot of those concerns has been discounted already by the market, so it's not like an unknown. And I think if you marry the valuation and the fundamentals, then we do like the investment thesis for Facebook.
So we're moving on to the last section now, which is questions about Blue Whale Capital. Are there any plans to launch an investment trust within the next couple of years? That's from Rob in Beverly.
We do not have any plans imminently in terms of launching investment trust. We have been asked about this quite a few times. I think if when we are ready, we would consider it, given that it's a different vehicle, it serves a different purpose for investors. But I think one thing I would caveat is the hurdle to launch an investment trust is much higher versus what we have done with the Blue Whale Growth Fund. When we first started the Blue Whale Growth Fund, if you remember still 3.5 years ago, we started with £25 million. And you can't launch an investment trust with £25 million. So I think the hurdle for us to get that traction would require a lot more work in terms of speaking to investors, getting interest, etc. But then I think there's an argument to be made that investment trust could be interesting for investors or even for us, is that we would have permanent capital in the trust, which means that we might be able to consider smaller companies. But for the Blue Whale Growth Fund is a daily NAV fund, open-ended, so people can come in and out every day. So we would remain in the large to mega cap area, which would not change. But in time, if we want to consider smaller company, maybe investment trust is the answer.
Thank you, Stephen. It's often said that investors should look for managers that have skin in the game. Is this the case for you? That's from Philip in Edinburgh, my hometown.
So about 4 years ago in 2016, the business Blue Whale Capital was set up then between Peter Hargreaves and myself. And we decided to take a long-term view in the business, and then we funded the business that day. So Peter and myself, we have skin in the company in itself. And at the same time, Peter also seeded the fund with £25 million of his own money, investing into the Blue Whale Growth Fund alongside our investors. And that is a lot of skin in the game as well. So for me personally, that all my liquid wealth would have been invested in the fund, not any other funds. And at the same time that I would only get paid if Blue Whale does well. If Blue Whale doesn't do well, then I don't get paid. So I think there's a lot more skin in the game than some other managers.
Absolutely. Which fund managers do you admire? Which funds do you compare yourself against? And how do you differentiate yourself? That's from Gavin in London.
So I've said this quite a few times. I have a lot of respect for managers that run a high conviction portfolio. And if you look at my sector, which is the IA Global sector, there are 300 funds. But there's only a handful of funds that run a high conviction mandate. And I already outlined earlier that it takes a lot of commitment, a lot of work to run 30 stocks in your portfolio. And you need to be quite confident in terms of the work that you go behind the scene. So if you ask me to name two, obviously it's people that I look up to in terms of their success since they started would be Fundsmith, Terry Smith, and Nick Train at Lindsay Train. I think they have done a lot of good to investor in terms of the performance. At the same time, I think it shows that it can be done. It can be done in terms of performance. If you believe what you believe in, then you would be able to translate that into performance for investors. But then we probably have too many funds in our sector that haven't done the job well, and they're still managing a lot of money for investors, which I think is the wrong thing. So we do want to join probably the right side, that we want to run a high conviction portfolio, and hopefully our performance would speak for ourselves in time.
Yeah, so I think we've got to mention there with Terry Smith for the next question. What do you see as the key differences between your fund and Terry Smith's Global Equity Fund? That is from Stephen in St Albans.
So we definitely have been asked a lot about this question since we started. I mean, that's exactly how we got started in the first place, running a high conviction portfolio. And I think the first bit is we share similar philosophy. I mean, I couldn't speak for Terry, obviously. I mean, you have to ask him. So we on a high level, from what I can see, is we share similar investment philosophy in investing into high quality businesses at an attractive price. But then I think if you look at the implementation, interpretation, understanding of the philosophy, is quite different. I mean, just look at our portfolio, look at our top 10 holdings versus Fundsmith top 10 holdings. I think we probably just overlap on PayPal or might be Microsoft, and there's a lot of other names that we have or he has that we don't have. So the interpretation and the implementation is very different. And then secondly, I don't know whether it's a good thing or not. I mean, we have just started. We are only 3.5 years in. We're quite nimble, like we're less than £1 billion in terms of AUM. And I think that's a lot for us to prove in the next 3 to 7 years versus Terry. I think he's already up here. We just started. So I think that's a lot for us, for us to do to prove ourselves.
Thank you, Stephen. What do you believe will be the biggest challenge to delivering consistent value within the LF Blue Whale Growth Fund? That's from Peter in London.
Yep. So Peter Hargreaves, who's the chairman of Blue Whale, he said something before that he feel that investment is about 95% perspiration and 5% inspiration. And if you ask me whether that's true or not, I 100% I believe it's true. And I think one thing that makes us a bit more unique is we have just started. I think that's clear. And then I'm in my early 40s, the rest of the investment team in their early 30s. So I think when you have people who are young and hunger, that we would work harder, we would try to do better, we would be more competitive in terms of proving ourselves. And I think that gives you an edge, what we can achieve in the next couple of years versus how we started. And I think at the end of the day, it's all about how much you wanted it to be successful. And obviously for us, because we've just started, that we are too early to talk about succession planning, for example. So we still have a long way to go on that front.
Thank you. Well, that brings us to the first part of the session. That brings us to an end there. And we'll now move on to the questions which you have submitted live. Again, we'll do our best to cover as many as possible. Okay, so moving on to Zoom now. Stephen, which holdings in the portfolio do you believe will benefit from the opening up of the economy and resumption of pre-pandemic activity? That's from Yasser.
Yep. So we have a couple, and obviously, I mean, we don't just invest into companies that have done extremely well, such as the technology-related names. So I think on a high level that we have medical equipment companies such as Stryker in our top 10, and everyone would know that the elective procedures has been postponed because the hospitals has been quite occupied with COVID patients, and as we open up or when less people going into hospitals for COVID, then the elective procedures should resume quite quickly. And there's been a lot of pent-up demand for those procedures. So unlike holidays that we might not be taking like 5 holidays next year. If you haven't done your elective procedures, you would need to get it done as soon as it permits. And then secondly, we do have big investment in MasterCard and Visa, both of them in the top 10. And the reason they have not done well since last year was because there's a lot of, they do make a lot of money on cross-border transaction, which means that if we're not traveling in Europe to use our credit cards in hotels or ski resorts, then they don't make those kind of money. So if we do have when the economy open up in the next 6 to 12 months, then these companies would be making a lot more money compared to this time last year. So those companies would be the ones that we have in the fund that would benefit from an opening.
Thank you. The next question we have is from David, and he wants to know, what importance do you put on dividend payments from your 30 to 35 companies?
We don't really look at dividends on a high level because this is not an income fund. So we invest into the company for capital growth. And I think if you look at the dividend that we pay since we started, it's minimal. So don't expect this fund is going to pay you any dividend. I think it really depends on the mandate of the company. So if you're saying this company have a lot of growth opportunities, as an investor who can take a long-term view in the company, would we rather, so let's say Microsoft does pay a dividend, a small dividend, about 2%-ish, would we rather Microsoft not to pay us as a shareholder and reinvest that dividend into the business? I think if they have the opportunity, then we would rather them to reinvest those dividends back into the business so that we would be able to capture more of that opportunity in time. But then if the company doesn't have that level of opportunity, such as Unilever, which is also a holding, they don't see as many opportunities, then yeah, as a shareholder, we would rather to have a dividend in our pocket so that we can redeploy those dividends into the likes of Microsoft, rather than Unilever spend it in the wrong area.
That's very interesting, thank you. If the fund gets larger, can this affect fund performance? Might you be forced to buy holdings at expensive prices? That question's from Adam.
We are still quite small in terms of the AUM of the fund versus the opportunity set that we consider. So if you look at our fact sheet, you will see that the average holding in the fund is over 100 billion sterling pounds in terms of market cap of our companies, and then obviously we are less than $1 billion in terms of the size of the fund. So I think until the time that we get into billions, like a couple billions under management, then maybe we will consider whether it's too big. The fund is too big for the opportunity set that we consider, but for the time being, we don't see any issues.
Thank you. The next question we have is from Sarah, and she wants to know, what is the reasoning behind not publishing the percentage weightings of the fund's top 10 holdings?
This is a very good question. I would probably point you towards an article that we published about 2 years ago on our website. It's about why is it so difficult for active managers to outperform the market, and that's why we have a lot of passive funds taking shares from active managers. One of the reasons is the level of disclosure in the market in terms of transparency. And what you have seen over the years is the market just increasingly become more efficient and efficient. And that's always a trade-off between the intellectual property, which we active manager have as in terms of the holdings that we invest into, versus the transparency or disclosure you want to make to the public. And we haven't have time to talk about this, but one thing when we talk about researching on companies is we do not use any broker's research. We do not speak to the sell-side analysts when we do research. One of the reasons is not because these people are not smart. The reason that we don't use those research reports is that those research are readily available to our competitors. We'll be reading this research from UBS, JP Morgan. Our competitor will be reading the same research. So what is the value? What is the unique point about that research? So I think that, so we try to do the best that we can. I mean, we try to share as much as we can, but we are also wary that I'm sure there will be a few competitors in this call today that want to get to know what we are investing in and pick some ideas from us. And I think we just need to be wary of that. And ultimately, the most important objective for us is to deliver the best performance for our investors, right? That is why we're here. If we feel that the things that we do would become detrimental to the performance of the fund, then we would avoid doing it. And I think oversharing of what we invest into at all times would have that effect in the fund performance.
Well, I think everyone will be interested to hear your answer to this question. What do you think are the key investment themes for 2021, and what are the current risks to the portfolio? That's from George.
I think we still haven't changed much in terms of positioning. I think on a very high level that we remain quite positive about digital transformations. I think one thing could be a disillusion to certain investors is you'll be asking, shares of Microsoft, Adobe, or even PayPal have done quite well over the last 12 months, and they should stop doing well in the next 3 years. I think that is the wrong conclusion, because there's a lot of benefit they have seen in terms of the subscribers, people getting used to the service such as Amazon. There's a lot of people who have never shopped at Amazon before, and now they got addicted to it because they feel that it's actually quite a good place to do your shopping. And that is not going to change, and that would only increase the competitive positioning of those companies. So I think selectively that we feel that digital transformations about working from home and shopping online, e-commerce would be here to stay. So obviously it depends on valuation. And for the company that we have in the fund, we feel that that's justified. The second thing, which we already talked about, is about reopening of the economy. What happened when everyone is vaccinated? What happened when we go on traveling again? Then you want to invest into the high quality businesses that would benefit, such as MasterCard or Visa. But we would not be investing into the likes of airlines, or like holiday makers, or even high street retailers, because they are low quality businesses. That's not going to change. So I think you just need to be highly selective on that.
Thank you. The next question we have is from Jean. She wants to know, can you comment on performance year to date? Is the recent NASDAQ sell-off making you rethink your strategy?
We don't really track the NASDAQ. Obviously, it's one of those markets that we're correlated with in terms of some of our holdings. I mean, some of our holdings would be the constituents within NASDAQ. What we really do is we already talked about this, is we are not worried about volatility. So if you're telling me the sell-off, which we feel it is just because people are rotating out of NASDAQ, taking profits, selling out, investing into airlines or banks, etc., we're not worried. We would see that as an opportunity to invest more into our company that we feel that the valuation is justified. So on that note, we are not worried about. What we really worry about is if our holdings got sell-off, but then is linked to fundamentals, which means that the company that we invested into is going to make less money in the next 18 months or 3 years, then we'll be worried and we will be acting on those decisions accordingly.
Thank you. We've got a question now from Duncan, and he's asking, what is your outlook on stock markets away from the US, specifically China and emerging markets? Can you see this portion of the fund increasing in the near future?
This is a good question. So since we started, the fund has been quite focused on developed markets, so mostly US, Europe, and UK. We have very little exposure to emerging markets or China or Asia. And one of the reasons which I talk about already in ESG is when you go into Asia or China or even the emerging market, the corporate governance is much weaker, much lower. And also the level of disclosure and transparency from the company is much lower versus the company listed in developed market. So you are trading off the quality of the business in Asia or China versus high quality businesses in the Western world. And unless the valuation justify itself, which means that those counterparts would need to be trading at a significant discount to the Western companies or counterparts, then we won't be interested. So that is something to be seen in time. I mean, to date, we don't feel that we need to be there to do better than the market. But in time, that could change. But it might take a long time.
Thanks, Stephen. Well, we've just got one more. We've just got time for one more of the live questions now, but it's an interesting one. It's from Barry, and he wants to know what your views on cryptocurrency are.
How much time do we have
exactly.
on this? So we don't invest in Bitcoin or crypto. I give you one high level take on this. I think firstly, this is a market for speculators. This is not a market for investors. We invest into companies. We don't invest into asset that you can't determine the intrinsic value. And what I mean by that is when you invest into a company, you can work out how much money they're making, how much cash flow that shareholders like us is entitled to. So you can work out some sort of valuation or what's the trajectory for Microsoft or any other name, even Amazon or PayPal. But then for crypto, how do you determine how much crypto is worth? And I thought about this example. I don't know whether it's a reasonable one. It crossed my mind that it's similar to a game of musical chairs. And so you basically have more people in a room versus chairs. And makes the chair or the seats quite valuable to people, because as soon as the music stops, everyone is going to grab that seat or the chair, right? And otherwise you get eliminated. And I feel that Bitcoin or crypto is very similar to that. But what happened if one day the few people decided to walk out of the room and not play the game anymore? Then you have less people versus many more chairs in the room. And it would make the value of those chairs less valuable. And I think that's what's happening with Bitcoin. If you ask me, would I be surprised a few years from today, Bitcoin is trading at $10,000, $20,000? Or Bitcoin could be going back down to $1,000 from here? I don't know the answer. It could go either way. I mean, would I be surprised? I'm not surprised, because you can't really determine the true value for Bitcoin. So I think a lot of people have got excited about Bitcoin just because it's going up. Sure, if you can be the first one to buy Bitcoin when it was trading at a much lower price, then you're making a lot of money now. If you're buying now, you're hoping that in the near future, someone is going to pay a lot more money for your Bitcoin. And how do you determine that? It's difficult. So for us, we are investors. We are not speculators, so we're not interested in Bitcoin.
Thank you, Stephen. We're going to move on to our closing question now. And that is, what's your outlook for Blue Whale in the next 3 years? And that is from Simon.
So thank you for this question. So when we first started, I think we set out to do much better than our competitors or the market. We have achieved that. The journey is still quite young, so we're only 3.5 years in, and there's many years for us to go. So basically, we have not changed our process. I think we have become better. We have made mistakes over the last 3.5 years. We have learned. I think we have improved dramatically in terms of how we can operate now compared to before. And we just hope to repeat the level of success that we have. And this is not just an outlook for the next 3 years. This is like an outlook that we need to have like every day, like we need to be better over the next 3 years. So I think even if you look at the composition of the fund, I mean, they on a high level, they are similar, but if you really look down the composition of the fund, they are quite different. And the reason it's different is because we want our portfolio to do the same, that you need to make sure that the portfolio is competitively positioned for the right opportunities for the next 3 years from now. So let's say we speak again in a year's time, I'm sure that 3 years got rolled over for another 12 months, and then we will be thinking along the same lines.
Thank you, Stephen. That's all we have time for today. I'll take this opportunity to thank everyone for joining us and for submitting the questions covered this afternoon. As mentioned earlier, a recording will be made available to everyone who signed up. I trust that you found Stephen's answers to be informative and helpful. We look forward to welcoming you at future events.